You could pick the absolute perfect mix of stocks and bonds, right? Like beat the market year after year and somehow still end up losing literally hundreds of thousands of dollars of your own wealth.
Yeah, which is terrifying.
It is. And the reason why? It's because you put those investments in the wrong accounts.
Yeah.
So, welcome to the deep dive.
Glad to be here.
Today, our mission is to decode this really fascinating guide from Davies Wealth Management. It's about a financial lever that most people completely ignore. It's called asset location.
Right. Asset location, not allocation.
Exactly. Allocation is what you buy, location is where you hold it.
And, the distinction between those two concepts is really where fortunes are quietly made or lost. I mean, we have this Vanguard research cited right in the Davies Guide that puts a hard number on it.
I love when they put a hard number on it. What is it?
So simply placing the right assets in the right tax environments, just doing that, can add 0.50% to 0.75% to your after-tax returns every single year.
Which, honestly might not sound like a lot at first glance.
Oh, but it is.
Right. When you run the math and you're compounding an extra, like, 0.75% over 20 or 30 years, especially on a larger portfolio, you are looking at a 6 or 7-figure difference.
Yeah, easily.
And that's what's so wild to me. You aren't taking on a single ounce of additional risk for that money. You aren't buying riskier stocks. You're not trying to time the market. You are quite literally just organizing your financial housekeeping properly.
It's pure structural efficiency.
Yeah.
And, whether you are a high net worth individual dealing with complex estate planning, or you're just someone steadily building your retirement nest egg, losing money to unnecessary taxes is a universal pain point.
Nobody likes paying more than they have to.
Exactly. The goal here is just to keep the money you've already successfully earned.
Okay, so let's unpack this. I like to use a visual. If building wealth is kind of like cooking a meal, your asset allocation is choosing your ingredients.
Okay, I like this.
Right. You need your proteins, your vegetables, your spices. But asset location is deciding whether to put those ingredients in the pantry, the fridge, or the freezer.
Which matters a lot.
If you put the ice cream in the pantry, well, you're going to have a sticky, expensive mess. And if you put the wrong financial asset in the wrong type of account, you have a massive, unnecessary tax bill.
That analogy actually holds up perfectly. Because before you can, put the groceries away, you have to know what the temperature is in each of those storage spaces.
Right.
You can't play the asset location game if you don't understand the rules of the board. And in the wealth management world, there are essentially 3 different tax climates that you need to master before you make a single trade.
All right, let's start with the most common one, the taxable brokerage account.
Yeah, the default.
This is your standard individual or joint investment account. There is no special tax shield here, right? When you earn interest from a bond, or say you sell a stock you've held for less than a year, you get hit with ordinary income tax rates.
And those can be brutal.
Yeah, the guide points out those ordinary rates can hit up to 37% at the federal level in 2026.
Okay.
So right out of the gate, this environment actively penalizes anything that kicks off a lot of regular income.
It really does. But, we shouldn't view the taxable account as just a burden because it heavily rewards patience.
How so?
Well, if you hold an asset in this account for more than a year, you graduate to preferential long-term capital gains rates. And depending on your income, those rates drop down to 0, 15, or a maximum of 20%.
Wow, so that's a massive discount compared to the 37% ordinary rate.
Huge discount. Plus, this account gives you access to a step up in basis for your heirs, which basically means if you pass away, the unrealized capital gains on your stocks are effectively wiped out for your kids.
Oh, that's powerful. So the taxable climate is harsh on short-term income, but very friendly to long-term holding.
Got it. Let's move to the second climate, the tax-deferred environment.
Right, so we're talking traditional IRAs, 401ks, 430. Yeah, and the pitch here is so familiar to anyone who has ever had a corporate job. You get a tax deduction today when you put the money in, and it grows without any annual taxation. It sounds like a fantastic deal.
It is a great deal on the front end, definitely. But there's a major catch on the back end. The toll booth is basically waiting for you at the exit.
Okay, break that down.
When you eventually withdraw that money in retirement, every single dollar, so both your original contributions and all the growth, is taxed as ordinary income.
Ouch.
And furthermore, the government forces you to start taking money out, whether you want to or not, through required minimum distributions or RMDs.
And those start at what, age 73?
Currently, yes, age 73. Though the Secure 2.0 Act pushes that to 75 by 2033. But the point is, forced withdrawals mean forced taxation. which interrupts your compound growth.
Okay, here's where it gets really interesting to me, and I want to make sure I'm understanding the math here.
Go for it.
Let's say I buy a tech stock inside my traditional IRA, right? And it absolutely explodes in value. When I eventually take that money out, I have to pay the higher ordinary income tax rate on all those massive gains.
Yes, you do.
Wait, so I completely lose the 15% long-term capital gains rate that I would have gotten in just a regular normal brokerage account.
What's fascinating here is that this is the exact trap millions of people fall into. They just blindly assume tax-deferred accounts are the absolute safest place for everything.
Because it has the word IRA in it.
Exactly. They think, oh, it's an IRA, it's a tax shelter. But by putting a high-growth stock in a traditional IRA, you are actively converting preferential capital gains into ordinary income.
Wow.
Yeah, you are voluntarily choosing to pay a higher tax rate on your biggest winners.
That feels like a massive oversight. I mean, you're taking an asset that the government is fully willing to tax at 15%, and you're moving it to an account where they will tax it at 32 or 37%.
Right. Which brings us perfectly to the third and final environment, the tax-free climate.
The Roth accounts.
Yes. Roth IRAs and Roth 401ks. You fund these with after-tax money, meaning, you've already paid the IRS their share up front.
Right.
But the ultimate prize here is that qualified withdrawals and literally all the compounding growth that happens inside the account over the decades are completely tax-free forever. Forever. Plus, there are no required minimum distributions for the original owner.
So it's the holy grail of accounts. But because the IRS knows how powerful it is, they severely limit how much money you can put into a Roth every year. Space is precious.
Highly precious. You have to be incredibly protective of what gets to live inside your Roth.
Okay, so we know the climates. The taxable account rewards long-term holding, but taxes income heavily. The tax-deferred account shields you now, but hits you with ordinary income rates later. And the tax-free Roth account is this limited space vault where growth is never taxed again.
That's the board.
Right. So now that we see the board, how do we actually systematically match our investments to the right accounts to, build this tax shield?
So the first major move is to quarantine your highest tax liabilities. You want to look at your portfolio and identify the investments that generate substantial, unavoidable taxable income every single year.
Okay, like what?
We are talking about taxable bonds, high-yield corporate debt, and real estate investment trusts, or REITs. These absolutely need to go into your tax-deferred accounts, like your traditional IRA.
Let's pause on REITs for a second, because the Davies Guide specifically calls them out. What exactly is a REIT, and why is it so toxic in a normal taxable account?
Sure. So a REIT is a company that owns or finances income-producing real estate. And by law, to maintain their special tax status, REITs are required to pay out at least 90% of their taxable income to their shareholders as dividends.
Wow, 90%.
Yeah. So if you hold a REIT in your standard brokerage account, you are getting a massive mandatory dividend payout every single year. And the IRS is taxing that payout at your highest ordinary income bracket. You are just bleeding capital.
Man, it's like leaving the windows open while the AC is running. So by moving the REIT or the high-yield bond into the traditional IRA, you lock the window.
Exactly.
You shelter that heavy annual income from the IRS today, allowing it to compound without an annual tax drag.
And you delay the bill for decades.
Yeah.
Now let's look at the complete opposite end of the spectrum. Your highest growth assets.
Okay.
Small cap growth funds, aggressive tech allocations, emerging markets. The guide dictates that these belong in your Roth accounts.
And the underlying logic there is just undeniable math, right? If you have an asset that you expect to triple in value over the next 15 or 20 years, you want 100% of that massive growth to happen in the permanently tax-free environment.
Right.
If an asset is going to grow by $1 million, you obviously want that $1 million to be invisible to the IRS.
You are maximizing the value of the tax-free real estate. But let's shift to one of the most counterintuitive nuances in the entire guide.
Oh, the international funds.
Yes. This is a rule that trips up even seasoned investors.
Yeah, this blew my mind when I read it. The guide explicitly states that international developed market funds should be placed in your taxable brokerage accounts. And my immediate thought was, wait, why? It's an equity fund. Shouldn't I want to shelter those dividends in a retirement account?
It seems like you should, doesn't it? But if you put an international fund inside an IRA, you actually lose a major tax credit.
How does that work?
When you hold international equities, those foreign companies pay dividends, and foreign governments, let's say Japan or Germany, they take a cut of those dividends as taxes before the money ever even reaches you.
Right, because it's their jurisdiction.
Exactly. So to prevent you from being taxed twice, the IRS allows you to claim a foreign tax credit on your U.S. tax return to offset what you paid overseas.
But there's a catch with where the fund lives, right?
A massive catch. You can only claim the foreign tax credit if the fund is held in a taxable brokerage account.
Right.
If you put that international fund inside a traditional or Roth IRA, the IRS essentially treats the IRA as a black box.
Oh, interesting.
Yeah, they don't recognize what happens inside it for current year tax purposes, so you lose the credit entirely.
Wait, let me make sure I'm really following this. I could be trying to do the responsible thing by putting an international ETF in my retirement account.
Right.
And by doing so, I am accidentally volunteering to be double taxed. Like the foreign government takes a cut, the IRS refuses to give me a credit, and then the IRS taxes me again when I withdraw the money in retirement.
That is exactly what happens. You suffer double taxation purely because of poor asset location.
Unbelievable.
If we connect this to the bigger picture, this is really why off-the-shelf automated financial advice often fails. You know, the generic robo-advisor algorithm might just see the label equity fund and automatically stick it in a retirement account, completely missing the foreign tax credit arbitrage.
That is wild. It really emphasizes why you have to look under the hood. Okay, so once you've correctly matched your assets to the right environments, you know, the heavy income bonds in the deferred bucket, the explosive high growth in the Roth, and the international funds in the taxable bucket, the guide explains that a whole new level of proactive tax strategy unlocks.
Yeah, you can start executing maneuvers that are mechanically impossible if your portfolio is disorganized.
Right, because asset location isn't just a static setup where you put things in boxes and walk away.
No, it is a dynamic foundation. Take tax loss harvesting, for example.
Which only works in your taxable accounts. Let's walk through the mechanics of this. Say the overall market takes a hit and your broad market index fund drops in value.
Okay.
You can sell that fund at a loss and then use that loss to offset other capital gains you might have. And if you have more losses than gains, you can actually use it to offset up to $3,000 of your ordinary income for the year.
It is a phenomenal way of converting a temporary paper loss into a permanent measurable tax savings. You're basically making the government share in your downside.
I love that.
But we do have to warn people about the 30-day wash sale rule.
Right, let's pause there because that trips up a lot of people. The IRS isn't stupid. They aren't going to let you sell your S&P 500 fund at 9 a.m. to claim a tax loss and then just buy the exact same S&P 500 fund back at 9:05 a.m.
They absolutely will not. The wash sale rule dictates that if you sell an asset at a loss, you cannot buy a substantially identical asset within 30 days before or after the sale.
And if you do?
If you do, the IRS just disallows the tax loss completely. So to stay invested while harvesting the loss, you have to buy a slightly different but highly correlated asset.
Give me an example of that.
Sure. For example, you might sell a mutual fund that tracks the S&P 500 and immediately buy a fund that tracks the Russell 1000. You keep your overall market exposure, but you satisfy the IRS rules.
That makes total sense. Now let's talk about market downturns on the retirement side, because the guide outlines a strategy for Roth conversions that is incredibly aggressive and, frankly, brilliant.
One of my favorites.
The strategy suggests intentionally holding some volatile, high-growth assets in a traditional IRA, not because it's the right long-term home for them, but because you are literally waiting for a market crash.
I know, it sounds totally counterintuitive to actually want to crash in your IRA.
Yeah.
But let's walk through the math.
Let's do it.
Imagine you have a volatile tech fund in your traditional IRA, and it's worth $100,000. A recession hits, and that fund tanks by 30%. So it's now worth $70,000.
Right.
Because it's in a traditional IRA, you can execute a Roth conversion right then and there. You move that asset into your Roth IRA at its depressed $70,000 valuation.
And because you are converting it, you have to pay ordinary income taxes on that move. But you are only paying taxes on $70,000 instead of the original $100,000.
Precisely. You pay tax on the heavily discounted amount. Then, when the market inevitably recovers over the next few years, and that fund bounces back from $70,000 to, say, $150,000, all of that rebound growth happens completely tax-free inside the Roth.
So what does this all mean for you listening? It means a market downturn isn't just a time to panic and check your statements through your fingers. If you have the right asset location architecture, A market crash is basically a Black Friday sale for a Roth conversion.
Yeah. This raises an important question for anyone managing their own wealth. Are you just reacting to the market swings, or are you using volatility as a tool?
That's a great way to put it.
By coordinating asset location with strategic Roth conversions, you are monetizing market volatility. You are literally turning market fear into a compounding tax advantage.
The guide also touches on state taxes, which is a fascinating geographic advantage, especially given that Davies Wealth Management is located in Florida.
Right, the state tax angle is huge.
Yeah. If you live in a high-tax state like California or New York during your peak earning years, you want to aggressively shelter your high-income assets in your tax-deferred accounts. Because later in life, if you retire to a no-income tax state like Florida or Texas, you can withdraw that money and completely avoid the state tax you would have otherwise paid.
It's pure geographic arbitrage. And beyond state taxes, proper location also helps high earners dodge the net investment income tax, or the NIIT.
Let's define that real quick because it sneaks up on people.
It really does. The NIIT is an extra 3.8% federal surtax. It's applied to investment income if your modified adjusted gross income sits over $200,000 as a single filer, or $250,000 if you're married filing jointly.
And what does it apply to?
It applies to interest, dividends, and capital gains in your taxable accounts. But here is the loophole. Distributions from tax-advantaged retirement accounts like IRAs and 401ks do not count as investment income for the purpose of this surtax. Yeah, so by purposefully keeping your heavy interest-generating investments inside those retirement accounts, you bypass that extra 3.8% drag on your returns.
It's like building a customized fortress around your wealth.
Wow.
But with all these sophisticated tools at our disposal, the guide does point out some fatal flaws.
Oh, definitely.
Even high net worth investors frequently sabotage themselves with a few common, easily preventable errors.
And I'd say the most pervasive mistake by far is what the industry calls the uniform allocation error.
Yeah, if you are listening to this right now and mentally picturing your own portfolio, pay close attention because you might realize you've committed this exact error. This happens when an investor decides they want a balanced portfolio, say 60% stocks and 40% bonds.
Very standard.
So what do? They log into their taxable account and make it 60-40. They log into their traditional IRA, make it 60-40. They log into their Roth, 60-40. They perfectly mirror the allocation everywhere.
It is incredibly easy to understand why people do this. Psychologically, it feels safe. It's diversified. It looks incredibly pretty on a pie chart. But visually pleasing is often financially destructive.
Let's break down why. Imagine a listener has $100,000 in a taxable account and $100,000 in a Roth, and they make both of them 60-40.
By doing that, they are completely ignoring the diverse tax climates we just spent all this time discussing.
Right.
In that scenario, they have $40,000 of heavy tax bonds sitting in their taxable account, bleeding ordinary income to the IRS every year. And they have $40,000 of low-growth bonds sitting in their Roth, completely wasting that precious tax-free growth space.
That hurts to even think about.
They're leaving massive returns on the table just for the sake of symmetry.
And speaking of doing the wrong thing in the wrong account, there is another major mistake highlighted in the guide, putting municipal bonds inside retirement accounts.
Oh, yeah.
Now, I love a good analogy, and to me, putting a municipal bond inside a traditional IRA is like wearing a raincoat inside a submarine.
That is exactly what it's like. It is entirely redundant. Municipal bonds are specifically designed to be federally tax-free. If you hold a municipal bond in a normal taxable account, you do not pay federal income tax on the interest it generates.
But if you put that same municipal bond inside a traditional IRA, you ruin it. Because remember, the rule of the IRA, everything that comes out is taxed as ordinary income.
Right.
So when you eventually withdraw that money, the IRS taxes it. You have literally taken tax-free income, put it in a submarine, and magically transformed it into taxable income.
It is the ultimate unforced error in wealth management. And to overcome these errors, we really have to address the final mistake, which is failing to rebalance holistically.
Right, because if you execute asset location correctly, your individual accounts are going to look wildly unbalanced.
Very much so.
If you looked just at your IRA, it might be 90% bonds. If you look at your taxable account, it might be 90% equities. And for a lot of people, logging in and seeing that makes them panic.
Because we are conditioned by every basic finance blog to want balance in every single account.
But you have to zoom out. The balance shouldn't happen at the account level. It has to happen at the portfolio level.
Yeah.
You are managing one total pool of money. It is just spread across different tax structures to optimize your yield.
Exactly.
Okay, so we've identified the environments, we've matched the assets, unlocked the advanced harvesting strategies, and pointed out the traps. So how do you actually implement this without pulling your hair out?
Well, the guide provides a really clear step-by-step process. First, you have to inventory everything.
Okay.
Just list out all your accounts and identify whether they are taxable, tax-deferred, or tax-free.
Simple enough. Step 2, you determine your total target allocation across all of those accounts combined. Decide your overall big picture mix of stocks, bonds, and alternatives based on your risk tolerance.
Second step is key. But step 3 is critical. You rank your specific investments from least tax efficient to most tax efficient.
So high-yield bonds and REITs go at the bottom of the efficiency list. Broad market index funds and municipal bonds go at the top.
Correct. And finally, step 4 is filling the bucket systematically. You start with your tax-deferred accounts, back them with your least efficient assets first.
Right.
Then you look at your Roth accounts and fill them with your highest expected growth assets. Whatever's left over. So your highly tax-efficient index funds and international equities flows into your taxable accounts.
Got it.
And you don't just do this once, by the way. You review this architecture anytime you have a major life event, like a career change, a move across state lines, or as you approach retirement.
And while the guide notes that the math is most impactful for large portfolios, I mean, a $5 million portfolio could see an extra $25,000 to $37,500 every single year just by organizing this right. I want to stress that setting up this architecture early in life is absolutely crucial.
Couldn't agree more.
Even if you are just starting out with your first 401k and a small brokerage account, organizing your assets correctly right now ensures you don't accidentally build a massive tax bomb for your future self.
The earlier you structure the foundation, the more effortlessly your wealth compounds. You are letting the intricacies of the tax code work for you rather than against you.
Which brings me to a final thought I want to leave you with. We talked earlier about the taxable brokerage account and how its hitting superpower is the step up in basis at death.
Right.
Meaning, if you hold a stock for 40 years and it gains $2 million when you pass away, your heirs inherit that stock and the $2 million capital gain is completely wiped out for tax purposes. It's arguably the greatest wealth transfer tool in the American tax code.
It really is a foundational pillar of estate planning.
But, tax laws change constantly. What if future legislation eliminates that step up in basis?
It has been heavily debated in Congress before.
Exactly. How would that completely rewrite the hierarchy of where we should hold our longest-term assets? If the taxable account loses its ultimate superpower at death, does the Roth become exponentially more valuable?
That's a great question.
It's a reminder that in the world of wealth building, you can never just set it and forget it. Something for you to ponder.
It really highlights why asset location requires continuous attention.
Because at the end of the day, building wealth isn't just about buying the best ingredients. If you want a meal worth remembering, you have to know exactly where to store them. Thanks for joining us on this deep dive.